Welcome to another edition of the Premier Investments and Wealth Management Financial Program. My name is Doug Wagner, and before I introduce the gentleman at the table with me, I would like to remind you that you can head over to premieriwm.com. Maybe you don't know if you're ready for retirement. If you're like most Americans, that's the way that it works. If you go to Premier Investments website at premieriwm.com, click Get Started, just answer a few simple questions. They'll provide for you, free of charge, no obligation whatsoever, a one-page Premier Vision document. What that can do is help you get an understanding of if you really are ready for retirement or for whatever financial idea you have for your future. You and your family, that's what Premier Investments and Wealth Management wants to help you craft that financial future for. So get in touch with them. You can even make an appointment online at premieriwm.com, or you can call them at 800-383-6590. Sitting just to my right, a wealth advisor, accredited investment fiduciary. He's a certified financial planner, professional, CFP, over 10 years of experience in the investment industry, Dr. Casey Mushrush.
Just to you, Doug.
How you doing?
Doing good, neighbor.
Good to see you again. Good to see
you
you.
too.
Jonas Everett is to his right. He's a wealth advisor with over 30 years of experience in the investment industry, but he just looks like he's 30. Hey, Jonas.
Hi, Doug.
Good to see you.
Good to see you. Love the fedora
Well,
today. Pretty awesome.
I'm getting bald, and it's a cold room, so I got to warm up somehow.
Nice.
So that's the way you do it. Also, to his right, he's the president of Premier Investments and Wealth Management, as well as a wealth advisor, accredited investment fiduciary, certified exit planning advisor, CEPA, with over 22 years of experience in the investment industry. Think we need a bigger boat. For the big kahuna, Roger Abel.
Well, thank you for that, Doug. And I promise you, my wife does not think we need a bigger boat.
Certified exit planning advisor. That's an interesting, I've not heard that one yet.
Yeah, we went to Focus this past year.
Mm-hmm.
I went to a breakout session
Right.
about business owners and their inability to really exit their business and how to get them to have a profitable business, but at the same time, figure out how to have the same amount of income, which is a challenge for most business owners. So I have a little passion for figuring that out and thought it'd be a fun designation to get. So I spent 2 weeks of my life studying more than I thought I would.
Yeah.
As I told someone this morning, I bit off more than I could chew, I think. But
Yeah.
I got it done.
That's good.
And now I just have to do the CEs every year.
It's all right. The work never stops.
You got it.
That's what the clients expect. Got a listener question for you, Roger. I'm going to talk to you about this one. Tony says, I just left my job a few months ago after the company restructured and I was offered an early retirement package. I wasn't fully ready to stop working, but it just made sense. I've been toying with the idea of going back to work. I like the routine and sense of purpose, but I've also been enjoying the flexibility of retired life. A buddy mentioned I should go to work for myself and start a business, but I'm wondering what your thoughts are in starting a business later in life. So you go from certified exit planning advisor to certified reentry planning advisor?
I guess maybe. I think I'd first start ask him how good of a buddy is this. All joking aside, I think before Tony starts a business, he should ask himself a couple of really key questions. Am I starting it because I'm passionate about it? Or is this just a job in disguise, which it could be? Then also, can you afford to actually start a business without putting your investment portfolio at risk? I think that's actually one of the very big challenges. And I think you should break this down in a couple of ways.
Yeah.
First, you have to determine, Tony, do you need to work again?
Do you need to?
Do you need to?
Yeah.
I mean, you left early. Your friend's telling you to start a business, but do you have to start a business? Because maybe Tony's just missing the structure, the camaraderie, some of the other things associated with going to work.
Right.
And I just had an individual I worked with recently listen to this radio show, exactly the same question, except he wasn't going to start a business. It was, do I need to go back to work?
Okay.
So he may go back to work for other reasons. I think the second thing about starting the business, there's some statistics Tony should know and understand. 22% of all businesses fail in the first year. And that's why I mentioned earlier, we should ask ourselves the question, can we do this without putting our retirement at risk?
Right.
2, 50% fail within 5 years. There's a 50% chance you will be out of business in 5 years. the top reason businesses fail is cash flow. So once again, do we have enough money to start a business?
Yeah. And again, I like the way you say it, and not risk what you've put together for retirement, because if you're staking your entire, I mean, literally that's you going to Vegas at that point. Okay, maybe a little bit better than Vegas because you got something in charge of it, but you're putting it all in the middle of the table.
Vegas might be better.
Okay.
I mean, 50-50. If you go to Vegas, it's not a 50-50 payout. Vegas, right? There's every machine has odds that it pays out.
Yeah.
Doesn't pay out 50 cents on the dollar all the time. Yes, you could win, you could lose.
Yeah.
But the statistics regarding business startups is pretty clear. The success rate is not great. And then above and beyond that, are you enjoying what you're doing?
Yeah.
I think this brings me back to the question or example I have. My wife and I always joke, if I ever decided to retire from this and take another job, it would be at Shields in the fishing department.
Yeah.
But the challenge is, and I thought to myself about this, all of a sudden when I try to turn the hobby into a business, is the hobby fun anymore?
Yeah.
And I did a event for the St. Croix rep. This is about 6 years ago. He called me up and said, Roger, can you go work this event at Shields? Outdoor. It was Saturday afternoon, 72 degrees, and the fish are biting. And the whole time I'm there, I'm like, why am I here helping someone sell fishing rods when I could be out fishing?
Exactly.
So, Tony, whatever you do, the key takeaways: 1, determine whether you need to start this business. 2, determine whether you really want to own a business. And 3, can you financially sustain a business without putting the rest of your retirement at peril?
That's great. And I tell you what, this is one of the neat things about getting to work with the folks at Premier Investments and Wealth Management that you'll get to understand is that it's more than just about the dollars and cents and the cash and the growing your money. It's about the psychology investing, the emotions that are involved in it. They work with you as their client. This is why Premier Investments and Wealth Management was named Forbes 2025 Best in State Wealth Management Teams. One of the reasons why, at least. PremierIWM.com. Call 800-383-6590. Jonas, question for you from Janie. My husband and I have been watching the news lately, and honestly, the political unrest around the world has us nervous. We're both in our early 60s and about 5 years away from retirement. We've worked hard to build our savings, but it feels like every headline could send the market into a tailspin. Should we be changing our investment strategy, or do we just stay the course?
Great question, Janie. I think it's important to realize that really half of Americans right now feel the same way, and investing is almost bipartisan right now. You have people super nervous and you have people super confident. One of the best things to do, I think, is to probably get a personalized financial strategy of some kind in place. That could be like a shield for you against the media. And really, we talk about, Doug, we talk about this how many years now? Probably 15 years now, developing some type of a media filter. Not one with Doug Wagner. You can take as much of Doug's information.
All the Doug, all the time.
All the Doug, all the time. But you develop a personal media filter, and what that means is, when are you going to take in the news? What type of content are you going to take in? What type of resources are you going to use to take this in? And really, if you look at the stock market as a whole, there's 3 different drivers of the stock market. You have corporate earnings, you have economic conditions, you have interest rates and inflation. So really, no matter who the president is, it really doesn't matter. The stock market's going to continue to do its thing based on those 3 different points that I mentioned. But you look at the 3 strategies. If you're super nervous right now, you try to build a media filter. When are you going to watch the news? When are you going to take the content in and develop a personalized financial strategy? One of the things that we really focus on, too, as a part of the strategy, Doug, is we talk about developing a personal bucket strategy. And that is, if you're right, Janie, and the market goes down and you're very worried about that, you have what we call the bucket number 1. You have a cash. I call it a spare tire. And you're able to almost turn market downturns into opportunities at that point.
It's interesting because when we look at this, when we were coming into the end of the third quarter, the beginning of September, end of August, people were like, Oh, September is always a dog month, and nothing ever good ever happens in September. September came, was more records. Every day it was like another record close, another record close. And it seems like, if you've got, even despite all those three things, Jonas, the market can do whatever it wants, whenever it wants, however it wants, and either you can lead, follow, or get run over.
And Janie, really, you have to realize that you're not alone with being nervous right now. I had a customer come in and they were so nervous about what's happening with the political environment. They literally asked me point blank, can we move all our money overseas right now? And I didn't have a very good answer for them, but that's very, very nervous. And that's after they did a bucket strategy. That's after they did a personalized strategy, financial strategy. So people are super nervous right now. I would recommend that you download the bucket strategy guide, go to Premier Investments and download the bucket strategy guide, and just know that you're not alone, and there's some things that we can do to help.
It's a very good point. And while you're at premieriwm.com downloading that, you can also download the Investor's Guide to Navigating Market Volatility. It's another really good one, because if you're concerned about volatile times, again, these current results are not necessarily indicative of future happenings, but at the same time, it is what it is. You take a look at this and you move forward at premieriwm.com, along with Roger Abel and Jonas Everett. Casey Mushrush, Dr. Casey.
Just you, Doug.
Got a question for you now. I'm 62, says Blaine, and recently went through a divorce that left me with some new debt I wasn't expecting. I know retirement's right around the corner, but I'm not sure if I should pause my retirement planning until I get this debt paid off, or try to balance both at the same time. What's the smarter approach in my age?
Yeah, Blaine, this again is something that we're starting to see pop up quite a bit, especially in today's age. And really the first step is making sure that you understand exactly the type of debt you have and how much it is, and how the divorce is going to end up affecting your income. So you have to recognize that you are shifting into this new financial paradigm. It's this new reality, and you have to figure out exactly where you're at and what you're going to be moving forward from. Really, when we look at this, it isn't uncommon at all. About half of divorcees actually find that they have some sort of new debt, or maybe a larger share of debt than what they were expecting when they're coming out of a divorce situation. Now, keep in mind that not all debt is created equal. Credit card debt and a low fixed interest rate mortgage are not the same thing. So making sure that you understand what that rate is and what type of debt it is going to be very important in figuring out whether or not you should try to use that balanced approach that you hinted at, or focus on paying down the debt as quickly as possible. Now, here's something that might surprise you a little bit. Alimony, or a change in that income, really can affect how both households occur, and it can actually, in fact, impact the income taxation, depending on the characterization of that type of income. So that is something that you might want to make sure that you understand as well, whether you're receiving the alimony or receiving child support payments, and how that may actually impact either the deductibility or the non-deductibility of those payments to you. Now, at age 62, you do have relatively short amount of time to keep building out your savings. So stopping the contributions completely could end up underfunding your retirement, depending on when it is that you're trying to retire. However, carrying that high interest rate debt can also have significant impacts on your future cash flow. So the balanced approach really would mean that you're keeping those essential retirement contributions, such as the 401k match or retirement plan matches, in place, while focusing on the high interest rate debt simultaneously, or paying that down at the same time. Now, back over to the strategy. Once Blaine actually understands where he is really sitting at, he can back into the numbers, and that's really what we take a look at on our side. What are the minimum contributions that are needed to keep retirement on track? How much of the excess cash flow can be redirected over to the debt in order to pay that down as quickly as possible? And this really does allow us to create not necessarily an all or nothing approach, but really an and approach, in order to try and make sure that you are working through a very methodical process. So the smartest approach really isn't about paying off debt or funding retirement on all or one. It's probably going to be some sort of a balanced approach. However, keeping in mind that that could change depending on the makeup and the type of debt that you have actually taken on as a part of the divorce.
Now, if you find yourself in a situation like Blaine is, and you want to go through this because everybody's gets like their own fingerprint, okay? Everybody's got an individual one. Your financial situation is going to be different than the next person down the street or the next person down the street. Go to premieriwm.com and you can request a meeting with any one of the folks, or you can also give them a call at 800-383-6590. Again, that's 800-383-6590. Premier Investments and Wealth Management named a Forbes 2025 Best in State Wealth Management Team. There was Dr. Casey Mushrush, Jonas Everett, and Roger Abel. A question for you. Before I get to this question, I want to say thank you because there was something I learned from you. I think it was one of the last 2 episodes about once my 401k hit an amount where now I'm starting to see that critical mass form where before when there was a 4% move in the market, it was kind of like, now there's a 4% move in the market. I'm like, ooh.
That's pretty cool.
It is. It is really cool now. I haven't experienced the backslide yet, and I know that's going to be there.
You know what, though? That it likely means you're getting to a place that's closer to financial independence. Mm-hmm. Because what you're probably referring to is you see the account go up 4%.
Yeah.
You're like, man, I might be able to live off that.
Yeah.
Right? And I'm guessing that's where the number's getting.
Yeah.
And that makes it fun. And it brings reality. Like, retirement might happen. I can now see where I'm going to get some income from it. So it is a cool spot when you hit the critical.
Yeah.
I'm 58. And I think that's actually a really important distinction on there, because oftentimes what we run into, especially in the financial services, we talk about percentages all the time. Oh, the market moved 1% or something like that. That is not the same as seeing that dollar amount on the screen or inside of there. And so when people actually are looking at their accounts and they can tangibly put that over to, that's the amount of money that I could have over the course of a month or a week or a year or whatever it is. That's really where it becomes a lot more real at that point.
Exactly. Like Michael, who asked this next question. I'm in my late 50s, so I appreciate that very much. Michael started to put together a retirement budget, Roger. Said he's listed the obvious things like housing, groceries, and travel, but he does not want to underestimate. His question is, are there expenses you see people forget to include when they're planning for retirement spending, or do you recommend adding an additional cushion to my numbers?
I love this question. Mm-hmm. We're going to call this the expense estimator.
I think my nickname in high school.
Yeah, I bet. Probably wouldn't be sitting here if it was.
Were you head of the accounting class?
No.
Here's what I want Michael to think about. When you start to build a budget, start to think in terms of needs, wants, and wishes. And we have really adopted this idea probably over the last 24 months. Mm-hmm. There's a lot of things that people don't think about in the needs section. They think about shelter, food, transportation. But what about all these other unexpected costs that can arise? Jonas, you brought up the home ownership deal one time. And after our last show, I don't know if I told you this, we got an email. Someone had sent an email in and said, oh yeah, by the way, my house has been paid for, but I think it was squirrels had gotten in his attic, $18,000. There's no way to estimate that. That's just having the slush fund and understanding that a paid for house doesn't mean a no cost house.
Right.
But let's talk about how to break it down. Here's the things that a lot of people will miss. A lot of people, when they come in here, forget about healthcare premiums. Mm-hmm. They don't. They think about what they're spending today. They're not thinking about what healthcare is going to cost in retirement, and it is not free. Mm. So we want to think about healthcare premiums. Start to think about car purchases. This is one exercise I walk people through. Cars are an expensive purchase. They're not $10,000 anymore.
No.
So we'll start to map out, how often do you buy a car? Do you buy a new car? Reminds me of my friend. When his dad came to him at 67, he was retiring, said, hey, I'm getting my last car. Mm-hmm. My friend chuckled like, what do you mean? You're not going to drive this for 25 years. He's had 3 cars since, but he hadn't envisioned the car purchase. What about the maintenance? You need to build in a maintenance budget for your property. It's not free. If you're going to live in a paid-for house for 20 years, you're going to need HVAC, you're going to need new carpet, you might need a roof. There's all these other expenses you're going to have. But the framework starts with needs, wants, what do I want to do in retirement, and wishes. When you put together a plan that incorporates these things, here's what happens. You end up front-loading retirement, meaning you push most of your spending into the first 10 years of retirement.
It's the go-go phase.
You got it. The go-go phase that we always talk about. You won't spend the same amount of money in the slow go. You just won't do it. But if you don't put together a plan that incorporates wants and wishes, you're going to live by the 4% rule. I had someone come in here the other day and ask me about the 4% rule. I said, well, that's a rule of thumb and you'll get an outcome. It probably won't be the outcome you're really looking for, but you'll probably be okay. And they asked what I meant by that. And I told them, I said, if your goal in retirement is to massively underspend, then the 4% rule is for you. It's true. You will underspend. Richard Bengen, I think, is the one who back tested the 4% rule. He's changed it 3 times. Increase the amount you could take drastically in the last time. So that's why we believe in segmenting your money and your retirement budget by needs, wants, wishes.
But the big thing is that when you do get to retirement, it's important to have that budget there, because if you make a mistake with your money in retirement, you don't have a whole lot of time, if any time, to recover from that.
It's a super good point. We've talked about it a lot. Make a mistake when you're working, pretty easy to recover. Get a second job, work longer. Once you're retired, it's tough unless you're looking to get back in the workforce, which very few retirees that I know, Doug, are looking to get back into the workforce because they made a bad money mistake.
Yeah, most definitely. Premier Investments and Wealth Management. Sit down and have a conversation with them. If you go to premieriwm.com, click Get Started. Just answer a few questions. They will provide for you at no cost and no obligation a Premier Vision document. One page has all the information that you need so you can take that next step. They'll also sit down and have a free meeting with you to go over the document. You take it with you when you go. Decide whether you want to become a customer. I know that's something that I've done, and I know the Premier Vision document has been attracting hundreds of people to their practice here at Premier Investments and Wealth Management, named to Forbes 2025 Best in State Wealth Management Team. Casey Mushrush, Donna has a question for you. She says, I'm 64, recently retired. My grandchildren live a few states away, and I'd love to spend more time with them by taking them, by having a place nearby. I'm torn between buying a second home, which would mean taking on a new mortgage, or just renting something when I'm there. What's the better option for someone in my stage of life?
Yeah, Donna, this is an absolutely, truly noble purpose. Getting closer to family, seeing people on a more regular basis, that is something that oftentimes we will talk with clients, and that is a major part of their retirement strategy, is being closer to family, being able to help out with those grandkids and being able to support the kids as well. One thing that I want you to think about is, how does a second property fit your existing cash flow, your risk capacity, and your retirement goals? Now, when we think about these different things, really you're looking at a couple of different options if you're looking for that second property. You kind of talked about this a little bit, but one of the most simple things is just paying for it outright. Simply putting money down, purchasing the property, then you own it. However, that can reduce the liquidity. It does tie up cash over in that property. Now, maybe you still have access through it, but it's through like a home equity line of credit or something of that nature, meaning that you do have a cost if you were to go try and create additional liquidity from that asset. You can also take out a mortgage. So it does preserve the overall cash, so you still have that in your pocket. However, there is that cost that comes along with it in terms of the interest rate, and then you also have that debt risk from that mortgage that exists as well. And really that third area or third option would be renting, which can keep a lot of flexibility in your situation, and you don't have really that long-term commitment, but it might be a more expensive option compared to the other two because you are paying for the cost of whatever it is to own that home, plus the additional profit margin for the landlord. Now, Donnie, you really didn't mention paying outright inside of your question here, which that could actually mean that if you do not have that available as assets, this may actually be a very, very bad idea for you. because this does introduce a lot of risk into your portfolio. Anytime we are increasing debt, moving into retirement, it's increasing the amount of risk that we are actually bringing into our financial situation. So it is possible that while maybe you have some assets or maybe you could afford monthly payments, you can't afford to actually do the purchase of the piece of property itself. So really the next question after that is, how does the property affect your day-to-day retirement expenses as far as your income and then also the outflows on that side? So if you're on a fixed or a semi-fixed retirement income, which most retirees are, you want to make sure that you understand how that's impacted. Roger just mentioned here front loading some of those retirement expenses, and you want to make sure that this could be something that would be coming over in here, and now you're overloading the front end of those retirement expenses, and you would be too lopsided on that side in terms of that additional cash flow coming in.
Casey, I'm going to make a point.
Mm-hmm.
That right there would be a want or a wish.
Exactly.
So if someone's organizing, you'd have needs. I need to have food, shelter, etc. I want to travel. I wish I could have a house.
Right.
This is the perfect example of why we break out those expenses.
Yes.
Like that.
Well, and it's almost like these things aren't done in isolation, right? Because all of this is called a continuum, all these different pieces really feed over into each other. So while this might be something that would be really nice, it may not be a necessary expense. Now, one other thing that she didn't mention, it is possible you could move. Change the location of your primary home, maybe taking equity from that existing place that you're in right now and moving closer over to the grandkids. I'm assuming there's some reason that Donna's looking at maybe a second home. Maybe she doesn't want to be there all the time, but that is maybe another option in there as well.
People like the idea of a second home.
Right.
Yeah.
And I can tell you, there's good things and there's bad things. Most people aren't looking at the negatives of the second home, which is time, energy, effort. It's not, you have a second property to take care of. It is a lot of work.
Who's there to take care of it when you're not there? What happens if something goes wrong while you're gone?
And if you're not there, you will be paying somebody else. Either you're going to hire a service or you're going to have an HOA fee. It's a whole nother layer of expenses. And I think to Casey's original point, at 64, if you can't pay cash, it's likely not for you.
Yeah. The other thing too is something else is you may want to extend this a little bit, but this whole idea of she doesn't know what she's getting into. If she just steps into it and says, I'm going whole hog and buys in, but then a year later, she's like, you know what? Maybe I should have done this. Maybe you need to take it for a test drive.
And the answer to that might be exactly that, doing the test drive strategy that you're using, right? So understanding, and one thing that I would ask you, Don, is how much time are you actually going to spend there? Because if the answer to that is it's just going to be a month out of the year, does it really make sense to go purchase a second home if you're only going to be using it a 12th of the time that you're going to be spending your time on that? Again, the upkeep and maintenance in another state, if we're going across state lines, can be pretty significant. There's another complication that we didn't even address on here, and that is the complication to your estate plan. Now, again, this gets over if we're owning property in multiple different states, that typically will dictate a different estate planning structure, right? I have a much more compelling reason to be utilizing a trust-based estate plan rather than a simple will-based estate plan if we have property in multiple different locations that we are now going to have to open up probate with. So one thing, that I would mention on here as well, and just let me tell you a real quick story. I actually had a client that considered something like this. And they were looking at purchasing, it was about a $175,000 home, and it was across state lines. And one of the things that we did is we sat down and looked at it and said, what is the equivalent if you were to jump over onto Airbnb and rent by the week? And it was about $2,000 a week approximately that they could go get a similar, same number of bedrooms, bathrooms, pretty decent place and still have kind of their own little landing pad at that point in time. So really what that translated for them was about 87 and a half weeks of living that was available to them without actually making the lump sum commitment and not having any of the additional taxes or any of the additional upkeep or any of the additional anything that comes with owning that second property. Now, we've also had situations on this where we've seen this not work out.
Mm-hmm.
These don't always have happy endings. And we actually had another client at one point in time that they came to us and said, I want to go buy the second home. We ran it into the financial plan. Roger, I know you know exactly what I'm talking about here. And it took their probability of success from a 92 to a 72. It was a significant swing to the downside.
It wasn't a no.
It wasn't no.
I mean,
it was
72 is like borderline.
It was. This is really probably not a good idea. This actually has a very significant detrimental impact on your likelihood of being able to maintain your spending. Guess what happened 3 years after they did this? They sold the property.
Oh, geez.
Because it no longer was feasible. It was no longer sustainable. Basically, they rushed over into the thing, and just a couple of years later, they said, nope, we're out. And they ended up actually liquidating out of that piece of property.
Everybody underestimates the extra cost. Everybody. They look at the purchase price of $175,000, pull out of their portfolio. Yep, I can do that. They forgot about the other $1,000 a month it's going to cost a minimum to have taxes, insurance. I have multiple clients who moved to other states. In every situation, they are spending significantly more than they ever thought they were going to. And their exact words to me, I didn't know it was going to be this much extra to have a second home.
This is why Premier Investments in Wealth Management can take the hundreds of clients that they have from across the country and bring the life experiences into you as well at premieriwm.com. Just go to premieriwm.com and you can make an appointment with any one of the folks that you see, one of the guys here at the table with me, and somebody else if you'd like to, or call 800-383-6590. Premier Investments in Wealth Management, named to Forbes 2025 Best in State Wealth Management Teams. Jonas, brother. Not Jonas Brothers, but Jonas. Question for you from Dane wants to know, I've started investing about 10 years ago. Honestly, I've never seen my portfolio look this good. I'm 55 and getting close to retirement. Now I'm wondering if I should lock in some of these gains while the market is high. Should I be taking some chips off the table?
Great question, Dane. A very popular question right now, actually. One thing that stands out to me is really, this is something that Roger said at one of our meetings, but market highs aren't a flaw, they're a feature of the market. And if we can take a deep dive, Dane, on when you're going to actually retire, that would be the most helpful thing. And once we do a retirement analysis, then we can come up and figure out how you can, what Warren Buffett said about investing is money in now for money out later. If we can do that retirement analysis. Another thing that stands out to me is after we do a financial strategy and we figure out your risk capacity, really you've only been investing right now for 10 years. If you plan on retiring in your 50s, one way to look at it, Dane, is you may not ever stop investing. If you have a very good financial plan and you're very comfortable with your portfolio, there's really no reason why you should ever stop investing. But we have a guide that's called Investor's Guide to Investing during market highs, which would be a great download for you. A couple of ways to think about this. If you look at your portfolio, what we try to do is we try to look at a meaningful period of time. And this is something, I think you put this together, Roger. This was pretty neat, and with Molly's help. But Halley's Comet, every 76 years. The Olympics are held every 2 years. There's a full moon every month. If you look at the stock market, there's new market highs, Doug, every 19 days.
Which is remarkable.
And ultimately, Dane, you need to ask yourself, are you an investor or a day trader? And if you come in and get a financial strategy, most people end up being long-term investors at that point.
Yeah, and that's the point too. Is it's something where it's not a bad thing to take money off the table if you have it. I mean, when you say take money off the table, it's like let's sell some of that and then I'm going to buy something else with it. It's part of rebalancing.
There you go. I walked customers through this the other day. We set up a bucket strategy. I drew it up on my fancy vibe board that I have.
Vibe board.
And that's what it's called.
I love it.
It's for educators. Okay.
Yeah.
It is. It's in the schools. Promise. Drew the cash bucket.
Yeah.
Then I drew our income bucket and the growth bucket. And they just asked, how would this be a sustainable strategy? And I said, well, when growth investments go up, we move some of the growth funds over to the income bucket. They go, how do you do that? They said, it's called rebalancing. That's all it is. Shaving a little bit off and buying more income, which gives them increasing income over time, causes more cash into the cash bucket. Rebalancing is really what Dane should be doing, not trying to determine whether to get in or get out. Rebalancing is taking chips off the table. Jonas mentioned figuring out your risk capacity. Well, if he's 80% stocks and 20% bonds, he would sell some stocks and buy a few more bonds. Pretty simple. And that's the way to take chips off the table and actually add chips to the table when the market's down too.
Dane actually reminds me of a younger version of Doug.
Oh, well then.
You said the same thing earlier in the episode, that your portfolio has never looked so good.
Better, yeah. I'm at this point where things I look at the difference when there's a change. And again, I haven't seen a negative one in a while, but I look at the sheer number, not the percentage change, but the number, the dollar amount in there. And it's really makes me happy.
And now it's time for you to schedule your rebalancing appointment.
Oh, yep, exactly. No, sorry about that. That's a very good point, and I'm going to have to do that with Mark. And also in my 401k, too. Roger, we're going to stick with you for question 7. This is interesting because it's sort of the flip side of the first question that we had at the original. Elliot says, I've spent the last 30 years building my business. It's been good to us. Most of my net worth is tied up in it. I don't have a big 401k or investment portfolio outside of the company, so when I think about retirement, I'm not sure how to turn what I've built into steady income. Do I sell outright? Do I try to pass it on to my family? Or do I find some other way to draw value from it? All right, certified exit planning, dude.
Dude.
Yeah,
I like it.
dude.
It's a CPAD.
Well, you got a vibe board, dude.
Schedule a meeting. I'll show you how it works.
Don't mean harsh, boss.
I like this question because this is where most business owners are at.
Yeah.
80% of most business owners, their net worth is locked up in the value of their business, and they have to figure out how to exit. It's not surprising that I don't have a big 401k. It's pretty typical. I think you have to ask a couple of main questions about this to yourself. Do you want to sell outright? Do you want it to go to a family member? Or do you just want to have income from it for a longer period of time? You have to ask those questions first. After you determine a little bit of what you really want to do, you're going to have to sit down with an advisor and figure out what your wealth gap is. And what I mean by that is if you have an income of $400,000, let's say, which would a lot of business owners have $400,000 incomes or more. And we're going to use some really crude math, which I don't really like here. 4% rule, roughly you're going to need $10 million of net worth to generate your income. If you've got $2 million in a 401k and you need 10, you have to figure out, is my business worth $8 million? And if it's not, can I get it to be worth $8 million? That might answer one of your questions. Should I just suck more value from it?
Right.
Maybe I have to work longer to keep that going. There's another issue with selling that business. And it's that, one, you're emotionally tied to it, but two, only 25% of business owners are actually happy that they sold their business. The other 75% a year later would tell you they wish they wouldn't have sold it. So there's a couple components you have to think about. You know, are you mentally ready to do this? Are you financially ready to do this? And is your business ready to do it? Because most businesses, if you look around and said, could you sell today for maximum value? 99% are going to say no. Most people haven't done any business planning. Think about all the business sales you've been involved with or have known, Casey. Most of the time they are sold because they have to be sold. not because they said, hey, this is my time to roll off in the sunset, death, disability, divorce, illness. There's all these other things that happen that make them exit at a non-opportune time.
And it's interesting to me is that how do you figure out what if you say, okay, I'm going to sell this, how do you structure it so I'm going to sell it so I can have regular income come in? How that happens, that's to me one of those confusing things, and that's why you have to sit down with somebody to go through this entire plan.
Yeah, you have to make sure you have a advisor, financial planner, financial advisor on your side that can help you figure out if this is sustainable.
Right.
And if you can do it, because otherwise it may lead to just having a lifestyle practice or lifestyle business that you're going to suck every dollar out of to keep your lifestyle going. Because if you're living on 400 and I tell you get 2, your family's not going to be very happy.
Yeah.
And one point too, Roger, for business owners, I think that they need to get away from this illusion that we talked about. And most business owners say that they're going to work forever.
No, they're not. It's not possible. There's death, disability. Here's why they're telling you they want to work forever. They're not confident they could exit and keep their lifestyle. That's really why. And they probably don't want to reflect and take a look and put the effort into seeing what they need to do today to get to the point they could have a successful sale. Only 25% of businesses actually get sold. Think about that. Someone invests their entire career into this business. It's their biggest asset. Only 25% of business owners are actually able to sell their business.
Interesting.
Well, and I think something you mentioned briefly too is the importance of putting that team around you. And it's not just the financial advisor. It's not just the CPA or not just my buddy down the street that's the business broker. It's having that entire team that's all going to be handling their own specializations.
Yeah, here's the team. I can tell it to you. CPA, financial advisor, exit planning advisor, valuation specialist, as well as a attorney. That's what you need. You're going to have to get a valuation specialist. There's about 5 key people on this team. And it's one of the reasons people don't do this. It's an extra level of work that they're not going to view as profitable today. It's the planning for 5 to 10 years down the road.
It's interesting the way you put that is that they don't see it as profitable for today, but it could end up helping them do the make or break. If you do that and you get somebody, you get a good evaluation, you can get a better understanding of how that works.
Well, here's the question you pose to somebody. If you have $2 million of assets and you need 10 and your business is worth 6, do you think you could get it to be worth 8 million in a year, or would 3 to 5 years be better?
Yeah.
So if you need to exit for that, why wouldn't you start working 3 to 5 years in advance versus 9 or 12 months?
Gotcha. Premier Investments and Wealth Management at premieriwm.com. You can make an appointment online if you've got a business and you're wondering these exact same questions, or maybe just one-offs too. Now, maybe you don't have a business. You want to find out if you can retire early, or maybe when I should start filing for Social Security. They're the ones to ask with these questions at 800-383-6590. Dr. Casey Mushrush, we're going to go for you. Final question here real quick. I have an adult son who's hit a few bumps financially over the years. I've helped him more than his siblings, covering things like rent, even some medical bills. Now that I'm updating my estate plan, I want to make sure things feel fair between all of my kids. How do I balance the fact that I've already given more help to one child while still keeping my estate plan equal and avoiding future resentment? Casey, what do you think about this?
Yeah, this is and Leanne, thank you for sending this in. This is a phenomenal question and something we run across not infrequently. Ultimately, this is your decision. And I'm going to leave you with a phrase that I learned fairly early in my life, and it is, fair is not equal and equal is not fair. So the best thing that you can ultimately do is communicate your wishes to your kids and make sure that they understand exactly where you're coming from. Now, let's break this down in plain English, okay? This is your decision. Estate planning is deeply personal. While I understand your desire to not want to create waves or to create resentment amongst the kids, at the end of the day, the plan should address and it should reflect what your desires are. There is no right or wrong way to divide assets. There's how you want it done, and then there's some mechanisms to make sure that that's actually what is carried out. Now, again, just to kind of go back to that phrase that I said, fair is not equal and equal is not fair. As you mentioned in this, sometimes some of our kids need a little bit of additional help during their adult life or maybe during their early parts of life. And this is something that you can reflect actually over within your estate planning documents. And treating everybody on a dollar per dollar basis may not be the most fair thing. So recognizing that they might be in different circumstances is something that you should be taking into account. And then the third part of that is making sure that you do have that communication over to your heirs, over to your kids, that they understand what is going to happen and that they know the reasons why. And you also need to just simply accept that sometimes there are going to be some things that you can't control. While we may look at estate planning as a way for us to, as much as possible, eliminate surprises, to try and smooth over the fights, if you will, sometimes you have kids that are just not going to get along and they are going to possibly create some problems for one another. You are not going to be able to control all of the different reactions. What you can control is you can control setting up your own plan and then making sure that other people are aware of what that is and how you are actually working through that. Now, just as a real quick example, I actually had an estate planning client not too long ago, and this is something we run into not infrequently, and this is undocumented loans. And what was going on in this particular situation is a little lady had lent one of her kids multiple thousands of dollars, actually, and everybody recognized that, well, this is a loan. Except it was never documented. It was a verbal, I'm going to give you X number of dollars, you're going to pay me back, $500 a month, and it's going to be done for however long. Well, about 6 months into the arrangement, son decided to stop paying because, oh, that's mom. I don't need to pay mom back. And so now we've got a situation where underneath a divide it evenly estate plan, that kid would ultimately have a larger share. So one of the things we ended up doing on that is we recognized and said, we have a situation where there is an advance. There is an advance against this kid's share of the estate. We have a mechanism to make sure that if we're tracking any of those inflows or tracking loan forgiveness, if you will, but it is an advance against the estate. Now, I did tell her that you have to make sure that your executor can do some relatively simple math to say, how much did they receive as the advance? How much has come back in? And once we have that, then they know what the adjustments would need to be done, if any, when she were to pass away. But it is something that we want to make sure at the end of the day that your wishes are actually what is carried out. Now, maybe there's a reason that you're helping that kid. And if there is a good reason for that, maybe that kid actually should be receiving everything. If that is what your wishes are because they're in a situation that they need it and maybe none of the others do, make sure your wishes are the ones that get carried out rather than simply going with what everybody else is telling you to do.
This is such a great question because I don't know how many households we help with this question, and we receive phone calls. I remember one where it was a remarriage and the father passed away from the first marriage, and the gal called me up and she said, I'm very concerned that he's not going to receive enough of my inheritance. Doug, and it was about a 3.5 hour phone call.
Yeah.
That we went ahead and I was able to get the backstory on everything, and we were able to determine and come up with a percentage that the customer really felt good about. But I think this is a timely and a great question.
Yeah.
Well, it's holiday season, right? We're getting close.
Conversations.
This is the old Premier joke.
Yeah.
Want to know the easiest way to break up a family reunion? Throw $100 on the table and see what happens.
That's absolutely
It's
right.
the easiest way. Put a little money on the table. We can break up a family reunion really quick.
You exactly could do that. Best way to bring them together is to, really talk about it. Communication is key, and that's what you get from Premier Investments in Wealth Management at premieriwm.com. Just click Get Started once you go to that website. Answer a few questions. They'll provide a free Premier Vision document and a free, no obligation meeting with you. They'll talk you through what their idea for your financial future is based on what your needs, your goals, your wants, your desires. It's personalized to meet your needs at Premier Investments in Wealth Management. Named to Forbes 2025 Best in State Wealth Management Teams. PremierIWM.com or call 800-383-6590 for Dr. Casey Mushrush.
Just you, Doug.
Jonas Everett, and the big kahuna Roger Abel. I'm Doug Wagner. We'll talk to you again next time.
Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in this show are for general information purposes only and are not intended to provide specific advice or recommendations for any individual. To determine which investments may be appropriate for you, consult with your attorney, accountant, and financial or tax advisor prior to investing. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is not a guarantee of future results. All indices are unmanaged and cannot be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal. There is no guarantee that a diversified portfolio will enhance overall returns or outperform a non-diversified portfolio. Diversification does not protect against market risk. Rebalancing a portfolio may cause investors to incur tax liabilities and/or transaction costs, and does not assure a profit or protect against loss. Premier Investments in Wealth Management and LPL Financial do not provide specific individualized tax or legal advice. We suggest that you discuss your specific situation with a qualified tax or legal advisor. Forbes Best in State Wealth Management Teams ranking was developed by Shook Research and is based on in-person, virtual, and telephone due diligence meetings and a ranking algorithm that includes a measure of each team's best practices, client retention, industry experience, review of compliance records, firm nominations, and quantitative criteria, including assets under management and revenue generated for their firms. Investment performance is not a criterion because client objectives and risk tolerances vary, and advisors rarely have audited performance reports. Shook's research and rankings provide opinions intended to help investors choose the right financial advisor and team, and are not indicative of future performance or representative of any one client's experience. Past performance is not an indication of future results. Neither Forbes nor Shook Research receive compensation in exchange for placement on the ranking. For more information, please see www.shookresearch.com. Shook is a registered trademark of Shook Research, LLC.